Hello, everyone. Welcome to the next episode of the Generational Growth Podcast, where we teach people to grow and give with abundance. We are at a time and point in history where people are going to have to start taking care of people. Cat is out of the bag. Corporations and governments are not going to save us. On top of that, we are in a society where financial education is not taught. My goal is to teach employees and small business owners how to increase their financial education so they could get to their why quicker and give in a meaningful way. I found that most people want to give back in a certain way, but they're not necessarily sure how. This podcast serves as an asset to allow you to do that in the most efficient way possible. So, on this episode, we'll be talking with my friend Kristen. This is our second episode, and we get more into the weeds on IBC. So, we connected. She's a fellow IBC practitioner, and we get into the weeds on IBC construction and how to use it as an asset to go buy other assets, and we dive more into her story as well too. So I really hope you enjoy this episode and stay tuned for more content.
I really wanted to talk more on your story as well too. I'm going to throw this up on my YouTube, and that's really what brought us together. We had a lot of overlaps and intersections with our stories, so really wanted to peel back the layers on how you got into this, and then talk about how you're applying it with your clients and what you're doing as well too. So I know COVID played a big piece into you getting into IBC and everything, but tell us a little bit more about your story. How did you wind up in the IBC space?
Yeah, so I'll back up quite a bit just to give a bit of background kind of on where I was at in my life when, and why things hit me the way that they did. So I got married super young, bought a house right away. We were barely 20 years old when we got married. And we were fortunate that we were able to buy a house right away. And it was fixer upper. We ended up like upside down in this mortgage, even though it was super cheap, just because the house needed so much work. And we had our kids super young, so we really we made the choice to live on one income, and so we really struggled with money for a long time. I did a lot of things on the side, so I was always before having kids, I was a bookkeeper right out of high school. I've always been doing bookkeeping on the side, even since I stopped working full time when I had kids. I book kept for like small businesses and stuff on the side. And then I would do like random things. Like I got into mystery shopping where, they would send you in for an oil change and you would fill out a survey and tell the company how your oil change was and give them all these
Right.
details in exchange for a free oil change. Like I did a lot of that
Interesting.
kind of stuff,
Huh.
which it was super fun. And
Yeah.
over the years, like I just did more and more of that until I got hired by one of those companies. And fast forward to around like a little bit before 2020, I had three kids. They were approaching teen years and they were all homeschooled. So my oldest did end up going to high school, but I was homeschooling my kids, so it was really important for me to still be home with them. And we had moved out of that house, but we were still always struggling financially. Like we couldn't seem to get ahead. And one of these mystery shopping companies hired me full time, and I just kind of kept progressing through that company, which was amazing. And it was such a blessing for us because I was able to work from home and work for this company and make, the better I did, obviously, the better my income got. And we had this money coming in, and it got to the point that I was working so much. I was like not homeschooling the kids like I wanted to be. I wasn't dedicating the attention that I wanted to be. I felt like the house was falling apart. I wasn't cooking meals. We were ordering in all the time. And it was a constant, like our life had become a reflection of the same way that we had dealt with money, which was a constant back and forth of like being stuck on this hamster wheel where we were, working really hard, pay off the bill. And then it would just, it just felt like we were treading water, and it was always, okay, after this month, we just have to get through this next thing. And when 2020 hit, I was kind of at like a kind of peak in this career where I was doing really well. I was working with all of these like multinational Fortune 500 companies and working around the clock and making a lot of money, but feeling like my family life had been completely neglected. And the more that I worked with these companies, the more I realized that I was not aligned with this lifestyle at all. I was working for these luxury brands, and I wanted nothing to do with the luxury lifestyle or any of these things. I just wanted peace. I wasn't after all these expensive things. It was the peace and the financial, not financial freedom in the sense that most people think, but the time freedom. Like, I didn't want to have to work around the clock to be helping these clients. I wanted to be just working for that time freedom. So all that to say, when 2020 happened, it kind of opened my eyes to not just my own career and that I wasn't enjoying what I was doing, but all of these lies. I think a lot of people had the same kind of experience, where it just opened your eyes to a lot of things that we thought were true and things that we thought were just taking care of us that weren't. And I had always kind of questioned things, hence like homeschooling my kids, but I never thought to question at the root, like what we do with our money. It just made sense to me that we put our money in the bank, and you save in the bank, and you save in Canada in the RRSPs. In the US, it would be like your 401k. Yep. And that's what you do. You just trust that the government gave you these programs to help you and help you save for retirement. And when I started questioning all these other things, finally the money thing hit me, and I realized, oh my gosh, I've never questioned this. Mm-hmm. And somehow infinite banking kept kind of coming across my radar. And when I really took the time to look into it, it hit me like a ton of bricks. Like, how have I never thought to question this? Like, where we keep our money. And if this works the way that it says it works in becoming your own banker, and I've read quite a few books on the subject, it blew my mind. And I just wanted to shout it from the rooftops that this is a thing. And this is like, you can actually have control over your money on the very base level. You don't have to put it in somebody else's bank to save it.
Yeah, I found it's generally fun, and it's become my passion to really teach the concept. It is so cool, not only from the investing aspect too, but like the greater why, like what you could do with some of these policy designs and everything is so cool. And I find it really rewarding. Like when you teach someone and it really clicks, like that you just unlock something for them that's going to give them tremendous benefit for the rest of their life. So it's really rewarding. It really is so fun to talk about this concept. But you mentioned not being aligned with luxury brands and everything. Let's go back a little bit further. Did you grow up in a small town too? I think that's
I
where
did. Yes.
Yeah.
Yep.
I had 518 people in my village, not my city or my town, my village, the village of Rosholt, Wisconsin. So tell me a little bit more about where you grew up at.
Yeah. So I grew up in the very southernmost tip of Ontario. So if you're American, it's like right down, we could swim to Detroit. Like we're very close that way. My town wasn't that small, but I grew up on like a hobby farm. My entire family lived, like aunts, uncles, cousins all lived within like the block of us on severed farmland from my grandparents. Oh, really? So everyone grew up super close. Yeah.
How does that tie into what you're doing now? Do you just kind of want to reconstruct that with what you're working towards, or where are you sitting now in terms of working with your family as you continue to grow and progress?
Oh, I love that question. So I've never thought of it in that way, but that's really what drove me, is just my family values of helping family out and being able to keep things. Keeping things in the family is not the right way to say it, but to be able to build your own family bank, it hit me so hard, because it would have made things so much easier for us if we had done this as a family group.
The Rockefeller,
right? Exactly.
Right?
Yeah.
I brought this up. So one of my good friends, Aaron Chapman, he's a really great lender over in America, and he's kind of living that model in real time. So he has it set up to where his kids, no kidding, will pay rent inside the trust. And now he's setting this thing up so all of his family is close together and everything, closer to grandkids and whatnot. But it's really cool to what you could do with these policy designs, and it's a thing, and people are doing it in real time, and you could do it on scale too. You don't have to be the Rockefellers and have billions and billions of dollars of wealth. It could be done on scale.
Exactly. And I mean, the Rockefellers had to start somewhere too, right? Yes. Everyone started at some point.
Yep.
And the most important thing is that they started.
Mm-hmm. Talk to me more about the transition that you made. So COVID popped off. You started to ask more questions about where your money is held. You started to realize that IBC is a potential route for you to go on. What other things led you to opening up your own business? Talk a little bit more about like the path in there. What happened?
Yeah, so I spent from the time that I learned about IBC, like that it kind of first, not even came on my radar, but from the time that I started kind of looking into it deeper, um, I I watched like every podcast I could possibly watch. I did that while I was working. Even I always had a podcast going in the background. If I was driving my kids somewhere, I had a podcast going. Um, I read and listened to every book that I could get my hands on the subject. And when I finally decided, okay, you know what, I have to make this jump. I have to just do this, just start it. I contacted someone who was in my area ish. At the time, the closest I could find was someone near Toronto. There wasn't anyone that was near my area. And when I reached out, he didn't give me the time of day. I got an email that said, here, it was like a copy and paste email, not even an auto reply. Here, read this PDF book that I wrote, and that was it. No way to contact him again, no way to book a call, nothing. And I realized at that moment that there was such a need for people like me that were just, their eyes were just starting to open to all the things in the world, and they're looking at different ways to protect their money. I also forgot to mention this earlier, but the biggest turning point for me was that made me, it was like a lightning bolt, really made me start looking for other solutions, was when the Canadian trucker convoy happened and the bank accounts were frozen. So when those bank accounts got frozen, I'm fortunate that mine wasn't, but I know people whose accounts were frozen over a $20 donation.
Really?
And yeah.
Wow.
And what scared me more than the freezing, honestly, was the lack of privacy, that this information was just shared.
Yeah.
I had, there was even a map that was circulating social media of my area of people that donated on a map. That, yeah, like my house literally showed up as a pinpoint on a map of people who had donated, so that if you disagreed with them, this is where you can find these people.
Yeah.
So the lack of privacy there really bothered me, and I felt like there was a lot of stuff going on that I wasn't comfortable with. So that's when I started looking for more private places to put your money, and that's how I stumbled on infinite banking.
Well, that explains it. That's
Yeah.
that's crazy. I didn't know about that one. I know that COVID had an interplay, but that is nuts.
Yeah.
I think it's history doesn't repeat, but it sure does rhyme. And what have you experienced on the client side too? I feel like these designs, IBC is becoming more popular because perhaps we're entering more periods of uncertainty. If you turn on, whatever's going on in current events, there's a lot of sketchiness going around right now, and I feel like people are starting to realize, hey, maybe I don't have as much control as I did before. Maybe this 401k and everything that I've been taught before isn't the right path. Maybe all of this money is going to what I'm kind of aggravated about in the news right now. So I feel like people are coming keen to the system that we're living in, both in the U.S. and Canada, because there's lots of overlaps there. Have you experienced that too? Are people more willing to talk about this concept?
Yeah, so when people book calls with me, that's the underlying theme of almost every single call that I get on, is that
Yeah.
they're in the same boat as me, where they were looking for other solutions. Hey, look, I heard that you do this thing with insurance, and I always thought insurance was a scam, but when you're being told to look one way, you should probably be looking over here, and this is kind of where I feel insurance is, right? So that's what made me look at it a second time.
Yeah.
And when I realized that, this is what like the Rockefellers have been doing forever, they've
Yeah.
been using these policies. This isn't something new. And I think a lot of people don't realize that this isn't a new thing.
Yep.
Insurance has been around in this way, that people use it as an asset class for over 100 years.
Yeah.
And
Something
it hasn't
that-
gone anywhere.
Yeah, two points on there, and this came from James Dyke's book, Pirates of Manhattan too. So in fact, there was deliberate marketing against these policies in the 80s. And you look at what happened in the 80s, well, it's the 70s and 80s, creation of the mutual funds and all the government accounts that house those mutual funds. There was deliberate marketing against these whole life policies to get people to store money in those mutual funds. So it's a thing. It really is a thing. The asset management industrial complex. It's real. It sure does exist. And if you get spun up on financial education and history, it's sitting there. It's sitting there.
Yeah, and there's a lot more people that are questioning just the whole money market in general,
Yeah.
and realizing, if you've read Robert Kiyosaki's Fake, he
No, I haven't
talks.
read that.
Oh, it's awesome. Read that book. But he talks about how all of these derivatives from the financial market, and how, most money is fake. It's not a real asset. And he goes back to, he doesn't talk about insurance specifically, but he talks about like gold and silver being God's money, and you want to have physical assets. You want things that are worth something, and not just a piece of paper
Yeah.
saying that you have a stock in the market just that's worth this much that could be gone tomorrow.
Yeah. Yeah. It's there really is no control with the traditional path, but you can control capital with some of these policies, and you could use it to go buy assets that are in alignment with you. And I'll throw this out too. I feel I should mention this. This isn't an attack on low cost index funds. I think there's great money to be made in the market, but I feel like where most people have issues, where I had issues personally, is allocations. I was dumping 80 to 90% of my monthly income into accounts that I had no control over. I thought I had control, but it wasn't in alignment. My goal was to go buy more assets and generate more cash flow so I had more optionality inside my life, but my strategy was not in alignment with that. So I found once I, shifted those allocations, got it more in alignment with my goals, then good things started to happen. I was able to buy more real estate quicker and scale up my real estate portfolio.
Yeah. And did you go completely away from the ETFs? Have you gone right out of the market, or do you still keep, still do a little bit there too?
Yeah, I went to about 80 to 90% to about 15 to 20%. Like I was saying, low cost index funds are great. It's just over allocations that were my personal issue. Then I just use these policies to fund down payments on real estate purchases. So I'll use that to finance the down payment, maintain some liquidity, and use bank money to go fund the rest of the purchase. Then do a little bit of private lending and hold some land lots too, and a self-directed IRA. But that's my core strategy. So still a fan of the market. There's great swings that are happening right now. There's always money to be
Yep,
made.
for
There
sure.
is no argument that's about one of the most easiest routes you could go to as well too. But I really found this, I'm sure you will relate to talking to different investors. Most people are looking for passive income, but then they're deferring the game until they're 60. So this is not in alignment with most people's goals. The tricky part is, I'd love to hear your feedback on this too, is one, getting approved, because a lot of people are unhealthy across the world. It's kind of a health crisis. And then two is like cutting through the political dogma, being able to check your ego and look in your mirror and say, hey, maybe I don't know, maybe my strategy's wrong, and maybe there's something I could be doing better. That takes a lot of intestinal fortitude, if you will. It's not comfortable. It's really scary too. I found a lot of fear when I was going through that process, and it's something that I prided on myself too. I thought I was squared away financially, but as I looked in the mirror and started to ask questions, I was like, damn, maybe I don't have it figured out, and maybe I have to pick up some books and really check myself.
And do you find that it's a lot of the case is just the indoctrination is maybe too strong of a word, but that's the path that we're all just taught to take? Like, that's almost the only path. Like for us in Canada, it's RRSPs. Like, you start saving in your 20s, you put so much of your income into an RRSP so that you can retire one day, and that's
Yeah.
it. That money has one job, one goal,
Yep.
and it's for you to spend way down the line, assuming that you're still alive then, and assuming that your life isn't going to change in any way then. But a lot of people are, for one, I find a lot of people are not saving. They're either not saving at all because they can't afford to, and they're just stuck in a cycle of debt, or same
Yeah.
position that I was in, where you just feel like you're treading water and your money's not doing anything for you. And they just, in their head, they think they can't afford to put that money away because it's gone forever. And that's, to me, where IBC flips the lid on, for most of my clients, because they come in and struggling. A lot of the time, honestly, mindset is the biggest issue, that they just have to relearn how to flow their money. But once they realize that, oh my gosh, when I run money through a policy, I can put that money to work twice. Like, it's growing inside the policy, and I can still use it for the things that I need in life, or to finance this other this real estate deal, or to finance this investment that was an opportunity that came up, and now I have cash to do it. Have you found the same kind of thing happen with your clients?
Yeah, so I think there was two questions in there. One was, is this all by design? I think that was the first one, right? So like,
Yeah.
are things constructed in a way to where it is, not benefiting the people? I wrestle with this one a lot, honestly. Want to hear your feedback on this too. I think it's a little bit of both, but I think that there really is no argument that our monetary system is not giving value to its participants. That money that you put inside of that 401k, that's being leveraged out to go do things that you probably don't want to have happen. And we're taught to really be indoctrinated. You go to school, a bell goes off. That came from the Industrial Revolution and everything. We're conditioned to not ask questions. We're conditioned to really just follow rules and be obedient. And that's real. That's truly is real. I don't think there's like a grand conspiracy and I'm split on it. I don't think it's all negative. We do have some individual ownership that we need to step up to, and like not be victims to the circumstances that we live in. But and things aren't set up in an easy to understand or a handle manner. I will say that. And then the second question was on mindset and everything, right? So can you rephrase that one? I want to make sure I get that right.
Um, I don't remember what we were talking about there. Maybe we can come back to that in a second, but just to go back to like us being, indoctrination again is the wrong word, but it's really, to me, it's a matter of where your advice is coming from, because you're taught that, well, you go to your financial advisor. Where do most people get their financial advisors? I don't know if it's the same in the US, but in Canada, you just go to your bank and you're assigned a financial advisor.
Yeah.
Amazing how that happens. And they sell you the bank's products.
Yep.
And they don't teach you about them. They don't teach you how to read the market, or how to they don't even teach you how to read your statements or what they're putting the money in. But you're under the impression that this person is really there to do what's in your best interest. I'm not saying some of them don't, but they only know what they're taught, and what they're taught is from the bank.
Yeah.
They can't even talk about things that they don't sell. They don't know about things they don't sell. So
Yeah.
that's a foundational problem before we even start about what they're selling, is just that they can only talk about what they make money on.
Yeah, I find it truly fascinating because I interface with people in industry almost on a daily basis. People from the stock market, people from real estate, et cetera, et cetera. It's truly, and people that have been in the industry for 20, 30 years, they have absolutely no idea that this concept exists. And you meet people in insurance too that have been doing life insurance for 2 decades, and they have no clue that this system exists. So it is wild, the amount of things that are out there that are just lacking in terms of a knowledge basis. And yeah, it's something that I've experienced, so truly, like on a daily basis, is education and lack of knowledge. It's not a thing, or it is a thing.
Yeah. And going back to the clients, with their mindset and just the way that they spend money, for me, what I see a lot is people that are in like their 40s or 50s, and they weren't able to save or they think they weren't able to save because they couldn't afford to put that money away forever. They were just too afraid of taking 20% of their income, or whatever the percentage is, putting it away and never seeing it, because, well, but I have things today, like I have needs today that I have to cover.
Yeah.
What if I can't cover those? And it's like a lock away, set it and forget it kind of mentality with retirement, when it doesn't have to be that way. Like,
Yeah, you
I
could
mean,
have your cash and spend it too.
yeah, like the way you're doing it, you're building cash flow. And if there's one thing I hope that people take away, is that Retirement isn't a number in a bank account. It's a number of passive cash flow, truly passive cash flow that is coming into your account without you managing it.
Yeah. And if you don't have any assets producing cash flow along that journey until retirement, that is going to significantly hinder you in your operations. But if you put some of that money to work for you now, albeit your 401k balance might be lower, but you will have 20, 30 years of growth of you actually buying assets that will make that, negligible. It'll be drips or drops in a bucket once you get to that point. But that's what we're taught, and it really sucks. And that's why we're on here putting this message out there. There are some alternative things that you could do to help build your financial system and growth and get in alignment with what you're trying to do and when you're trying to get there. On the mindset side of things too, you mentioned not only the techniques of infinite banking, like becoming cognizant of the whole leverage system that you could do, but have you encountered like any mindset hurdles that typical clients have? Like, is there a way of thinking that people tend to have that doesn't really allow them to understand the process, and how do you overcome that?
Biggest mindset, I guess there's two, but the biggest mindset hurdle that we have before we even start talking about policies is getting people out of that lack mindset. So you can live in lack or you can live in abundance. And if you're living in lack, and it's not budget, it's not income that determines that, it's the way that you think about it. So when you're looking at life and you wake up in the morning and the first thing you think is, oh my gosh, I can't pay my bills. I don't have this thing that I want. I want this, I want this, I want this. I can't afford blah, blah, blah. And you're stuck in that. That's the biggest hurdle I find that people have. Once they get over that, getting into the policies and how they work, that part is easy. But getting them to jump from that scarcity into abundance and into the thought process of from going, I can't afford that, into, you know what? How can I afford that?
Boom.
If I want this thing, I can make this happen. How am I going to do that? I haven't figured it out yet, but I will.
Yeah.
That's such a huge dump for so many people.
Yeah, and I love that, the scarcity versus abundance concept. And the way you get to abundance is typically, how can I help people in the most efficient manner? How can I give value to other people? That will bring about that abundance and get you out of that scarcity mindset. Another one that I've seen a lot is focusing just on rates of return. So if you do a rate of return calculation year one, and you're just looking at the stock market versus the whole life policy, it's not going to make any sense, right? But what are you leaving out of that internal rate calculation? And especially when you're thinking long term, well, it's opportunity cost. You're inside of a tax-free vehicle, and you could apply leverage to go buy assets. When you do that and you look at that opportunity cost after 2-3 decades, then it becomes a no-brainer, because that isn't calculated inside of your year one internal rate of return. If you do things in a vacuum, just looking at that small time block, no, it's never going to make any sense. But you got to think about, you have to have an understanding of like what money is, because for that to actually register, you have to know what leverage is. You have to know what tax planning is. And once that becomes cognizant, then you could get out of that trap. But really, to make that hit, you have to talk about money. You have to talk about leverage. You have to talk about what this all is. And this ties into the monetary system. And it's getting people back out of that, you said indoctrination. It could, honestly, the word fits, getting people out of the indoctrination that we've been taught and seeing other paths that exist.
Yeah, and on the same kind of wavelength, just talking rate, just talking interest rate. Well, what's the interest rate that I'm earning? What's the compound interest rate? That's the wrong question.
Yeah.
That's not how it grows. You need to look at the big picture. And then same with loans. When they look at loans and they're focused on the rate, and they don't understand that it's not just the rate that matters. It's the, like you said, opportunity cost. It's the having the ability when banks wouldn't give you financing. It's often lower than bank rates anyway, but it's all of these things that factor in, that you really need to open your mind and look at a big picture, as opposed to just what we're taught to look at that narrow line of oh, this is the rate of return or this is your interest rate that you're earning, because
Yep.
it's so much more powerful than that.
Opportunity cost. We were talking a little bit before about, I work mostly with real estate investors, but I'm working a lot more with business owners as well too. So in Canada, do you guys have key person insurance, executive bonus arrangements, things like that? Is that something that you work with your clients as well too?
Yes. Yeah, I don't do as much corporate.
Mhm.
The I love corporate cases. I love working on them. But the family market is really more where I shine. I get more
Sure.
fulfillment from that because you see the difference that it's making in people's lives versus a corporation.
Yeah.
But yes, I love it inside of a corporate policy. If we think personally the advantages are good, they're through the roof when you're looking at a corporation. This is
Yeah.
how the wealthy stay wealthy. This is truly how they're not paying any tax inside their corporations and how they're passing money on one generation to the next.
Yeah, I really like the small business niche too, because like you get a little bit of that family tie-in, under 15 employees too, so you could get, integrating and everything, but you could still have that same whole life chassis, but your premiums pending your entity structure, that could be a write-off too. So it's a great way to tax harvest, and then you get all those same benefits too. So you're inside of a tax shelter, and you could use that leverage to expand your business. You could use it to go buy more assets, expand your balance sheet. But it's been a really cool, we'll call it a category that I've been jumping into. It's really sweet to work with those business owners and bring the same whole life chassis benefits to other clients. But good to know. I didn't know that Canada's rules were all the same. But interesting.
Yeah, there are
Let's.
some different tax rules, I'm sure, and different ways that like our premiums are never deductible,
Oh, they're
or
not.
almost never, I should say.
Uh-huh.
Yeah, premiums aren't, but the death benefit can go outside of the corporation tax free. So that's where we talk about transferring the money out
Okay.
on
Okay,
death.
gotcha.
So yeah, there's a lot of just a lot of really great opportunities that are there. If you're incorporated and you have excess capital in your corporation, this is by far the best way to keep that capital growing and
Yeah.
keep your tax bill down.
Yeah, yeah. Lower your tax liability so you could go buy more assets. You could do it with some of these plans that are inside there,
Yeah.
and while protecting your business at the same time. We were talking earlier. We had a connection to Mike Wolf. Mike Wolf has done a tremendous amount in my real estate career, helping me really shape and perfect the turnkey model. But so he's an investor over in Canada. That's where he's from. But you mentioned that you're doing a webinar for him, and I would love to hear the details of that. I remember I did a bridge connect from Mike to you because you guys are obviously from Canada. But yeah, I would love to learn a little bit more about how you're pairing that turnkey real estate model with the IBC strategies.
Yeah, so I'm going to do a webinar for mostly for his community, but I'll open it up. I'll make sure you get the link and you can share it with your audience as well, um,
Yeah,
if you have
cool.
anyone in the Canadian market. But even if you don't, I mean, you can help them in the U.S. market. But
Hmm.
the idea of using your policies to run cash through, so that you have your own banking system that you can use as the capital to
Hmm.
help you with these real estate ventures. So personally, I have clients that have like flip houses,
Hmm.
um, and it's so beneficial when you have your own policy that you can use. Like when we have these policy loans that don't have required repayments, you can borrow from this. It doesn't show on your debt ratio. It doesn't show on a credit report. You can borrow from it for your down payment, whatever you need to do, and nobody's hounding you if your flip takes an extra year to do. We all
Yeah.
have we've all heard those horror stories. I've had those horror stories where you go in and you open up a wall and oh crap, this job turned into having to gut the whole house.
Hmm.
And when those happen, now you have something to fall back on and you don't have to go back to the bank lender and you're not struggling to repay the bank loans because you can't flip or rent out this house for another 12 months.
Yep.
It buys you time, it gives you a lot more control over your capital, and it lets you be able to be your own bridge in between, rather than, like, I'm sure you have horror stories too of going to bridge lenders and the astronomical rates that they charge for that.
Yeah, it's expensive, and then there's late fees too. There's a schedule, and what's great about this, it's relatively cost effective. It's typically 1 to 2% less than the market, and then you get that flexibility too. From business owners and flippers, real estate professionals, we may have good years, we may have bad years. You have the flexibility, optionality to let that interest ride if you want to. Maybe you're doing a flip later on, you could just wash out those loans in the back end. So you have that cost effective and flexible debt. So you mentioned lots of flippers, and then is that the main avatar in the real estate space that you've encountered too? Because I came from the real estate space, so I could kind of break down my journey and everything. But is
Yeah,
that
if you want to talk about your journey as well, I've mostly dealt with the flipping market,
yeah,
because what we're doing is taking once they do the flip, then
yeah,
they put all of their earnings back into the policy, right? Put as much premium in as they can. They have more money to borrow again for the next house, and
yeah.
then now they can buy a bigger house or a multiplex or a couple houses, whatever it takes, right? So they just keep upping their scale.
Yeah, well, sweet. Let's tie it in. Let's tie like the flipping concept into some more short-term rentals and
Yeah.
long-term rentals, some other real estate investors too. So I mentioned a little bit about my story. I was a former Army officer, West Point guy, and through that path, I was mostly just focused on government accounts. So I maxed out all those government accounts, and then when I got into real estate, this is before I got my financial education. I was just using a high yield savings account and bonds to save up for my different rental down payments. So no kidding, I would save up to 30 to 50K, and then I'd go back down to zero when I took that money out. Save up again, go back down to zero. You're like a dog chasing its tail because there is no leverage capability. And then on top of that, you are taxed the entire time during that savings journey, which sucks. So what the system allows you to do, what I found, it's a system to allow you to capture those down payments. Those you could capture those down payments that you're saving up to. Those could continue to grow in a tax-free manner. Then you could apply a line of credit, again going back to that cheap and flexible concept, apply that line of credit while that money remains intact and grows tax-free to go buy that asset. And then that asset is, if you're doing it right, is probably going to generate some type of cash flow. That cash flow could pay off the interest that you paid to the insurance company, and you just rinse and repeat that cycle. And before I used to capture all of my my rental emergencies and my personal emergencies in a high yield savings account too. I started to just capture it inside of the policy as well too, because it's building towards the expanding my banking system. It allows me to earn more dividends and growth. So again, I could go buy more real estate, and it's allowed me to scale in a way more efficient manner because those dollars are going to work for me. They're buying assets that are in alignment with me increasing my cash flow goals. It's completely different than what I was doing before, just locking money away until I'm 60. And I think this is worth mentioning too. So a lot of a common problem that I see with real estate investors is, okay, how do I get the seed capital to actually fund this thing? So what I did personally, I'm not sure if Canada could do this, but I took some contribution dollars from my 401k and my Roth IRA, and I used that as my one-time lump sum to actually fund the policy. I think I remember you were saying you actually can't do a one-time lump sum, but my tax bill for that was $0, and that's what I used to rapidly buy some deals right out the gate. But maybe there's some ways to get around that. I'm just not sure.
Yeah, I don't know of any of those in Canada. We have like the first time home buyers plan, but that wouldn't apply to rentals or investment properties. Um, yeah, we have a lot more taxes than you do,
Yeah.
unfortunately. Um, but yeah, I love that. And can you just go into a little bit more detail? Because
Sure.
people get so tripped up when they hear about loans. Because I didn't hear you say anything about paying off the principal on those loans.
Sure. Yeah. So when I am keeping that debt intact, so if I take a 50K down payment out to go buy a turnkey piece of real estate, typically my down payments are going to be between 30 and 60K. The cash flow will keep that debt intact. So personally, all my loans right now are between 5 and 6%. So the cash flow will keep that intact. And then I have my premium contributions coming in on a monthly basis. And really, the game that I play is how quickly can I restore that loan balance? How quickly can I restore cash value inside my policy so I could go buy another asset? You do have that flexibility to let that interest rate ride, if you will. But the more you pay back that loan balance, the more liquidity you will have, and then you can go make another asset purchase. So with me in the phase that I'm in the phase of how quickly can I move with real estate, and that's how I'm constructing my loans right now. Is I set that bar that covers my emergency expenses, my rental expenses. As soon as I have enough liquidity to go buy a cash flowing piece of real estate or whatever asset that I'm doing, I go ahead and make that transaction, and that's I just rinse and repeat that cycle.
Now, this is a conversation that I have with practitioners all the time. Is it better to put money into premium or pay off a loan?
Ooh, that is a good question.
If you had the choice, because a lot of the time we do have to choose between one or the other.
Yeah.
If you haven't maxed out your policy, or
Yeah,
what do you personally do?
this is what I've heard. It's if you are not planning on buying an asset, if you're not planning on expanding, maybe that money is probably better served in opening up another policy so you can start to build expansion bank system size. I mean, if you're not looking for purchasing an asset, you're not looking to expanding, then just paying off that loan balance is more than likely um, that's the bar, that's the gauge that I use to determine whether I'm going to go buy expand my banking system or go buy an asset. And I'm in the phase right now to where I'm buying assets. So most of my money is just being recycled and going to go buy more. When my business income increases, or if I get an increase in different lines of income, then I'll just use that money to go open up a new policy.
Now, do you use any kind of, like, how do you pressure test these policies so that if interest rates went up, you would still be cash positive?
So yeah, I do. I got like an investor book when I'm analyzing all of my deals, and I'll make sure the cash on cash, all the internal rate of returns, check out, and that's what I do when I'm pressure testing. I may run, a plus or minus 1%, just to see like what I would be looking at. But a lot of times with this is what I picked up with real estate. A lot of times, cash flow is not really my main concern. I feel the most of your money is going to be made in appreciation. So I often buy deals that are cash flow neutral. They're not making any money. They're just being attacked, but they're in the path of progress to where the deal still does make sense. I didn't start that way. I started off with a more cash flow focused model, but as I progressed, it makes sense to do more appreciation plays because I feel like I can handle that hit. I feel like cash flow plays are a little bit more secure. They allow you, it's like training wheels. You're still backed by that cash flow if something bad were to happen, if appreciation doesn't shake out the way you want it to. But as I feel like you progress, you can start to make a little bit more appreciation plays. Mike will even say this too. Like sometimes you could buy a property to where it's cash flow negative, but the appreciation and all the tax benefits inside there still make that deal worth it. So it's important to run a holistic analysis when you're looking at that deal and how it ties into your greater tax and wealth situation.
Yeah, and really what purpose that particular deal has as part of your portfolio, because we have different purposes,
Yeah.
just like
This
you
is
would in a money portfolio, right? You
yeah.
have different things that you would want your money to be doing within your portfolio.
I think this is another thing worth mentioning too. The terms of the deal, the terms of the loan that you're getting on that piece of real estate can oftentimes be more important than the deal itself. Case in point, for one, this Wichita property that I'm closing, I'm doing a 7-year arm on it, so it's locked for 7 years and then it's variable after that. You may hear that, and I heard that as I was, getting educated on this concept. I was like, no variable interest rate, no way I'm touching that with a 9-foot pole. Get this out of here. Kind of like the IBC concept a little bit ago, right? But then I looked at my intent with what this property was. My intent is to get rid of this thing within 5 to 7 years. So that actually made a lot more sense to me, and I was able to do only 20% down with this 7-year arm, and the internal rate of the rate of return was better. So I had more liquidity, not doing 25% down, got a better interest rate, and allowed me to get a better floor plan too with the purchase that I made. So the terms of the deal are oftentimes just as important, if not more important, than the actual deal itself. And if your lender's not doing that and running multiple different scenarios for you, That's a red flag. You should probably have a different lending team, and Mike and a few other people can make some of those connections for you because your team should all be working cohesively to support you in your purchases.
And another thing too, just because you're talking about rates, one thing that I love about using insurance is such a stable asset that they're both dividend scales and loan rates tend to move very, very, very slowly. They don't
Yeah.
jump like the market, like where we see, Bank of Canada or the Fed cut rates, so interest rates are going way down. We don't see that. Our insurance companies' rates are always fairly low compared to the market, but they also don't go up like crazy. They don't go up on a day's notice.
Yeah.
Once a year they may change a little bit, but it's such a slow curve one way or the other. It gives you a lot more security when you're looking at a long-term plan.
Yeah, the analogy that I love here, it's like building a house on a foundation of, a rock solid concrete foundation or a foundation of quicksand. If you apply leverage from the market or even a HELOC out of your house, what happens if Iran kicks off? What happens if COVID 2.0 kicks off? If you have outstanding loans and your market value crashes, that sucks really fast. But
Yeah.
if you are applying leverage and you're backed by the guarantees inside these policies, well, it gives you that foundation. It gives you a solid foundation that you can continuously apply leverage to go buy assets. And it's nice to know you have that control and you're backed by those guarantees as you're applying the leverage. And I found that is really in alignment with what I'm trying to do. And it's worked tremendously well versus doing a HELOC or leveraging from different stock accounts.
Yes. So last question I have for you. So what do you find is the most important part of infinite banking? If somebody's looking to implement infinite banking in their life, what do you think is the most important part for them to be successful? What do they need to do?
For me, the thing that pops up is what are you going to do with it? What's your intent? What's your why? Because this might not even be a good fit for what you got going on and what you're trying to do. So focusing really hard on what you're trying to do, what your mission is, and then we can backwards plan to make sure that's in alignment. But so why and intent would be the main thing that I'm focusing on.
Yeah. And I think you hit the nail on the head that what are you going to do with it? It's not just buying a policy.
Yep. Yeah.
People can come to you all day long, hey, I want to buy an infinite banking policy. And there's no such thing. That's not, I can sell you a policy designed for infinite banking, but the infinite banking part is the work that you do as the client.
That
It's
is
what
a
you do.
Yeah, that's really good framing. I like that a lot. Yeah. Would you say that's the same thing? Would you say you would agree?
Yeah, I was hoping you were going to say the same thing because
Yeah.
exactly to me that's the single most important part is your client's behavior because no one can make those decisions for you, and if you're just buying a policy and leaving it and that's just your savings plan,
Yep.
yes, it'll work, but it's not going to work. It's not going to make you wealthy. No one ever got wealthy from insurance
Yep.
unless you're the person at the top of some of those MLM companies. But like, like it's not going to make you instantly rich.
Yeah.
It's what you do with the capital. You have to put the capital to work in order for it to grow to its potential.
Yeah, and it opens up a whole can of worms on doing your due diligence for that asset, right? Because we're just playing arbitrage, and if we are playing arbitrage and we're playing negative arbitrage, that's not a good game. We want to play positive arbitrage, and in order for you to play that in the right manner, you really got to do your own due diligence. So this is just the foundation. When you're building your house, there's still a lot more work to be done, but this is a really great foundation.
And so I guess I do have another question. In your experience investing in real estate, what would be the best way for someone to start if they wanted to just get their feet wet in real estate?
I think right now a lot of people are having problems with different down payments and getting in. So I really like the concept of house hacking. That's how I got started. I used my VA loan, but I'm not sure what Canada has, but you could use a FHA loan, and that could really help you get into a property in a pretty rapid fashion without having a really sizable down payment. And then, so that's lane one. And then lane two would be improving your savings vehicle. I used IBC to help me scale in a more efficient manner. And then you could just rinse and repeat that process. The way it works, like with the VA loan, so every year you can move, and that re-ups your eligibility. So you could jump into another property with 0% down. While you have that lane two running in the back end, it could really help you scale in a more efficient manner. So looking at low down payment options while saving in an efficient way in the background is how I would address that.